Welcome, everybody, to this Founder Institute online event today. We're going to be speaking about financial modeling. My name is Dustin Betts. I'm a community manager at the Founder Institute. For those who don't know the Founder Institute, we are the world's largest pre-seed startup accelerator. We've now helped launch more than 6,000 portfolio companies in programs across 200 plus cities and more than 95 countries. So if you're interested in learning more about the Founder Institute, we are enrolling for accelerator programs now on all 6 continents. And you can see that list of enrolling programs at fi.co/enrolling. With that out of the way, today's topic is how to leverage a financial model to supercharge your business. And I think, one of the sort of preconceptions about financial models is that they're for fundraising, but they're not just for fundraising. They're also essential for gaining an in-depth, deeper understanding of your business, how different elements of your company's finances interact with one another, and how you can strategically improve your startup's overall financial performance. So our guest today is going to share tips on how to use a financial model to track the most important metrics in your business, as well as how you can use a financial model to optimize your company's processes from that. So this event today is for any founder who wants to make more data-driven decisions to run a better business. And thanks everybody for joining us today. Be sure to put your questions in the chat. I really want to emphasize this. We want to make these events as interactive as possible. So at any point, I have a producer, Felicia, in the background who's going to be helping to gather up your questions. So don't be shy. After I turn the floor over to today's guest, you can put the questions in at any point. Then when we get to the Q&A, we'll have them queued up and ready to ask. So without further ado, today's featured speaker is Logan Burchett. Logan's a finance MBA with several years of CFO startup experience. So his expertise comes from providing financial leadership to dozens of different rapidly growing companies, and in that capacity, aiding them in securing millions of dollars in funding. So currently, Logan is the co-founder and COO of Forecastr, which is a software platform that helps founders forecast revenue, predict runway, gain a deeper understanding of their numbers, and ultimately get funded, which he's going to talk more and share the tool as well today. Prior to Forecastr, Logan spent a number of years acting as an outsourced CFO for pre-seed to Series A startups across the Midwest, where he constructed hundreds of different financial models and helps them to raise millions in early stage capital. Welcome to the stage, Logan. So excited to have you join us today on this really important topic for founders to have a firm understanding of.
Yeah, thanks so much for having me, Dustin. I really appreciate it. And without further ado, I'd love to just jump in and start chatting about financial modeling. So I'm gonna go ahead and share my screen. And first off, I just want to thank everybody for coming to this. I'm really impressed by the attendance here, and I really am very grateful to have a platform to be able to chat with folks about this. And thanks to the Founder Institute folks for putting this on as well. This is a topic that I am super excited to be talking to you all about, and it's specifically around how to use a financial model for fundraising. And as Dustin said, it's not just for fundraising financial modeling. I mean, it typically gets kind of pigeonholed into that one use case. There's a variety of cases for financial modeling operationally and otherwise, but today specifically, we're going to be focusing on the fundraising aspect of financial modeling. And it is a topic that's very near and dear to my heart. Whenever my co-founder, Steven, and I went and originally raised money for Forecastr, we had basically no traction, right? We had no revenue. We had no product. We really had nothing, but we had an idea, and we had our backgrounds, and we had a really great financial model to tell the story of how we wanted to grow the business. And we leaned really, really hard on our financial model while fundraising because we didn't have a product, we didn't have revenue or anything like that. So we had to find other ways to de-risk the investment for these potential investors. And we were pulling this off by giving the investors confidence in our financial plan. And it was a way of showing the investors that we could be good shepherds of their investment, and also hopefully proving to them that we had some idea of how we were going to be growing the company as well. And fundraising is hard work. There's no doubt about that, but there are tools out there to help make fundraising a little bit easier. And a great financial model is absolutely one of those tools. And it's my intention today to prove to you that it's one of the most powerful tools in your fundraising arsenal. And I don't want to belabor my background because I was given such a warm introduction already, but I'll just skip over this slide and suffice it to say that I know an embarrassing amount about financial modeling. And you'd be hard pressed to find somebody that knows the startup finance game better than me and my co-founder Steven. So I'll leave it at that. Maybe one other thing that I will say though, just in relation to my background, is that Steven and I do have direct fundraising experience in that we've raised about $5 million for Forecastr. We've grown it to a team of 25 folks. So not only do we kind of like know the theory of some of this stuff, we put it to practice as well for ourselves and for clients that we've advised as well. So, and if you're not familiar with Forecastr, I want to make it clear that today is not going to be a sales demo or anything like that, trying to get everybody on Forecastr, but I do think that it's helpful just to get a little bit more context on what Forecastr is. And Forecastr is an online software that helps founders build great financial models so that they can understand their numbers, make better decisions, and of course, topic for today's conversation, get funded. And the heart of what we're doing is we're making forecasting easier and more meaningful for founders and investors because we love forecasting. We think that it's one of the most important things that you can do for your business. But we really don't like Excel, which is funny because we used it professionally and we're deemed to be experts by most folks. But we don't like Excel when it comes down to financial modeling because Excel's clunky, it's hard to learn, but perhaps worst of all, it's unstandardized. So that means that every model is different. So it's really hard to compare data or automate or anything like that. And with Forecastr, we strike a nice balance because every model is still unique, but it is standardized in our platform. So that way you can compare yourself to your cohorts, you can link up data sources. The act of having it in the software just makes you as a founder a lot smarter and more efficient. And I like to say our best feature is that we have a team of experts that help all of our customers along the way from the initial build of the financial model on through any ongoing questions that we have. So if you are interested in Forecastr, I think we've got some team members that are going to be in the chat. If you all want to go ahead and put a link to apply for the beta, we'd encourage everybody that's interested to apply to work with us. And just to talk about a really quick agenda for today, I want to talk about the power of a great financial model. So kind of what is a financial model going to help you do holistically? We're going to talk mainly about how to present your model to investors. That's really kind of the meat and potatoes of today's content is once you've got a financial model built, how do you ease that into the conversation with an investor from kind of like an introductory standpoint, just giving them an introductory like visual into your financial model on through any deeper due diligence meetings. What does that look like? And we're going to spend some time today looking at Forecastr's financial model as well, going through what an investor grade financial model looks like, and then give you some strategies and some tips for how to go about that conversation and how to ease people into your financial model. But before we get into any of that, I want to start at the very, very basics of today's topic of conversation. I want to make sure that we're all on the same page of what exactly a financial model is. And this may seem like a really basic question, but I've given this talk several times at this point. If you ask 100 different people this question, you're more than likely going to get 100 different answers because a financial model has a ton of different functions, and thereby it really starts to take on a bunch of different definitions depending on who you talk to. Some people will say a financial model is a expense budget, or maybe they'll talk about it as more of a hiring plan or a cash forecasting tool. There's a real wide span of things that a financial model could do. So there's a lot of different definitions of how people think about financial modeling. Now, the best definition that I've ever heard comes from a guy named Troy Hennicoff, who's a mentor of ours. He was the former managing director of Techstars Chicago. And he likes to use an analogy to describe financial modeling that I've stolen from him with his permission, of course. And it goes like this. So way back in the early days of car manufacturing, the design phase looked a lot like the pictures that are shown on this slide. So you'd have these engineers that would build out these full-scale replicas of their designs, and eventually they'd create full-on prototypes of these replicas. So you can see this guy in the lab coat here on the right. He's making like a big clay life-size model of a car that he hopes to mass produce one day. So once they shape everything exactly the way they like it, they'll build a completely working prototype, and they'd have to find some brave soul to go in and test this prototype in real time. And sometimes these prototypes would work fine and you could go on to mass produce the car, but then sometimes the car would flip over into a barrel roll while you're trying to take that sharp 90-degree turn. But the point is, the only way to actually know how it would work is to just build the car and see. So engineers basically had to create an entire car just to see if their concept worked. And a lot of times it didn't, and then it was back to the drawing board. And they'd have to iterate on this several times. They'd iterate after iteration after iteration, and they'd have to spend millions of dollars. And eventually, they might have a car. It's kind of crazy by today's standards because these people are wasting a ton of time and energy and money, and they're risking lives in the process while doing this. So thank God for technology, because nowadays cars are built completely soup to nuts using software. So you can design and test a whole car in minutes instead of months. And you can build this virtual car and put it on a virtual track and then have it take a virtual 90-degree turn. And that way, if it flips over, it's not a big deal. Nobody gets hurt. You just tweak some components. You maybe lower the center of gravity. You try it again until eventually you get it right. And the idea of building out a full-on physical prototype before software testing is pretty laughable by today's standards. And we think that this is a great analogy for financial modeling, because in the same way, we can use technology to simulate our business, and we can run tests in minutes instead of years. So I can see what happens whenever I add a new product line, or I try a new marketing channel, or maybe I invest in a sales force. And for really early folks on the call, you might even just get an understanding of, is your business viable, or do you need to completely switch up your business model entirely? In a way, what you're doing is you're saying, hey, can my business handle this sharp 90-degree turn? Is it going to be okay, or is it going to flip over into that barrel roll? But this way, if there's issues with your company, that's not a big deal, because nobody gets hurt. Not you, not your investors, not your co-founders. And it really gives you a fighting chance to optimize before jumping in head first and wasting a ton of time and money. And when built correctly, you'll have a completely distilled working simulation of your business, which can be one of the most powerful tools in your arsenal, operationally and specific to today from a fundraising perspective as well. And once you've got this simulation built, it's going to be able to answer all kinds of difficult questions, many of which I'm sure you all have heard before from investors, many of you that are fundraising. I threw some of the common ones up on the slide that I've seen stump founders in the past. So how much are you raising, and why are you raising that much? Founders usually are going to have a really great answer for the first part of that question, but a lot of times we'll see them falter on that second part. So you really need to get a good understanding of your uses of capital. Otherwise, it looks like you're just fundraising without a plan, right? Who specifically are you planning to hire, and what impact does that have on burn? We see that 80% of most startup costs are people. So everybody needs to be accounted for, and that's a very big part of your budget for how you're going to be spending the investor's investment. How do you plan on growing the business? So what specific actions are your teams going to take in order to ensure that the investor has the greatest chance of returning a profit? That's kind of de-risking the operational strategy from an investor perspective. And if your model's buttoned up, you can have really rock solid, bulletproof answers to all of these questions. And what that does, the more answers you can give to these difficult questions, it's taking risk away from the investors. And that's really what a financial model is all about from a fundraising perspective, is just de-risking the investment for the investors. Now, we're asked a lot by founders, hey, when should we invest in a financial model? And a lot of times these earlier companies will claim that, hey, they're too early. They don't have enough of their business figured out to, in their mind, adequately build a forecast. And in our experience, having a financial model at kind of the seed stage and below, the model acts as more of a separator between you and other startups. And this is because investors don't necessarily expect you to have a really great buttoned up investor grade financial model whenever you're this early. And you can certainly get a round done without one whenever you're kind of at the seed stage and below. So it's more of a separator. Now, that being said, standing out from the crowd is really important while fundraising, especially whenever you're really early on. Investors see hundreds of deals a week, and they have to turn down pretty much all of them. So your best chance for success is to try to eliminate all possible areas of risk. And financial risk is certainly real when it comes to early stage investing. So I've already shared our story of how we leaned heavily on our financial model to get our pre-seed round done. And we've had several seed stage companies that have said investors have committed to their rounds after seeing their financial model. So It's a great way to stand out and build confidence, which is really, really important while fundraising. So that's kind of the seed stage and below. Series A and beyond, a great financial model is just going to be table stakes. You've got to have it. There's really no way around it. Investors are going to be expecting to dig into your financial forecast during due diligence. So our advice is typically just invest the time and the energy into getting a financial model built early on, because you're going to need it later and it's going to pay a lot of dividends down the road. So now I want to talk about how to showcase your financial model to investors and go over the method for looping your projections into the conversation and really using it as a tool to further the relationship and to build trust. And I have to note that for the purposes of this presentation, we're going to assume that everybody has a financial model built. We're not going to be able to cover how to build a financial model soup to nuts in the time that we have today. Now, if this isn't the case for you, if you don't have a financial model built already, we'd love to have you as a Forecastr customer. We will get you a model built if you choose to work with Forecastr. But if you do choose to go at it alone, again, we have some folks in the or some Forecastr team members in the audience that will share some really, really helpful templates that we've put together. So Mitch and Jeff, if you guys want to throw that in there, if you're interested, take a look at that. That'll be really helpful whenever you're trying to figure out where to start when it comes to building a financial model. But I want to start by talking about specifically how to use financial projections in your pitch deck. Now, the key to showing projection slides in a deck is to keep it really high level and just not get too deep in the weeds. So this is a sample of our financial projections that we used during our pre-seed round. And the goal of this slide wasn't to convince investors that we had the world's greatest financial model or that we had every assumption buttoned up to the nth degree or anything like that. We were only really just trying to show them that our business has the potential to be really, really big. And essentially, we wanted to show them that this opportunity is worth paying attention to. And we just wanted to keep it really, really high level out of the gate, just pique their interest, right? We keep it high level for a couple of reasons. So the first reason is that an initial pitch should be focused on getting emotional buy-in for your company. So you want the investor to get excited about the opportunity, and you need to use this time to sell them on your vision, not necessarily the financial outcome that may be there. If the investor is not excited about your company, then there's really no point digging in further and spending a lot of time digging into the financial outcomes. You really need to get them excited first and then do that on the back end. The second one is just going too deep into numbers too early leads to number fatigue and analysis paralysis. It's likely either going to shut the investor down, so they're going to lose focus, or it's going to lead the conversation off track and go into some super deep financial specifics. And we've got plenty of examples where we've seen companies focus too early on financial conversations, and investors get hung up on one metric that maybe they don't agree with or an assumption that they don't agree with. Before you know it, the 1 hour meeting is completely blown by and you've made no progress with the investors. So just focus on vision, getting them emotionally bought in. Remember, initial pitch meetings are not meant to be deep dives into the unit economics of your company. If you focus too much time on it, you're just going to burn a lot of time in what's meant to just be a short, concise pitch meeting. But the third and most important reason that you don't want to, give too much information early on in the pitch deck is you want this slide to be the hook to get your next meeting. That's the secret weapon of presenting financials in your pitch deck, is that it can act as a hook to get the next meeting. Because whenever you put numbers like the ones I just showed on a slide, really savvy investors are going to want to dig in and understand more how you got them. So you want them to ask, hey, where'd you get those numbers? And that gives you a chance to set up a time specifically dedicated to going through this. And that's going to lead to more face time with the investor, which is going to lead to more trust. And those of you that are on the call that have fundraised before know that fundraising is a game of building trust. And investors invest in founders they trust, and trust is built through familiarity and through confidence. And getting a meeting set to go over your financial model is going to build both of these things. Another meeting is going to lead to greater familiarity with you, between you and the investor. And going over your financial plan is going to build confidence that you know your numbers and that you're going to be a really good fiduciary of their investment. Super important. So now I want to go into how to execute that next meeting. And to be clear, this is a meeting that the agenda is specifically for you're going through your financial model. So at this point, you've shown them your pitch deck, they've seen the financial slides, you've piqued their interest. They say, hey, how did you get those numbers? I'd like to dig into that more. And now you've set up a time specifically to talk to the investor about those numbers and walk them through your financial plan. I typically recommend scheduling at least an hour for this. This can be a pretty heady meeting, but this is what we're going to be focusing on for the next slide. It's just that more deep in the weeds, more diligence meeting. And for the purposes of just going through this, we like to break it down into 3 different time periods. Seems obvious, but it's easy to, I think it makes sense to kind of section it into before the meeting, during the meeting, and after the meeting. So let's look at them each individually. So before the meeting happens, we recommend that you don't send the investor your financial model. And people have a lot of different opinions on this. We feel very strongly here. For the record, I have the same opinion on pitch decks as well. You don't want a model to live on its own. You need to control the narrative and present the model to the investor either in person or on a call. And this will do a couple of things. So one, like we mentioned earlier, it's going to give you leverage to get that next meeting. So if they are in fact interested in your business and they do want to dig in, they can do that, but they need to do that with you in the room. They can't just do it on their own going through your financial projection. This is just another way to get face time with the investor. So it's a hook, again, to get that face time again. The second thing is that it's going to demonstrate your understanding of the model whenever you do actually present it. And in showing your understanding of your financial model, you're going to be showing your understanding of the business. Because if you remember, a financial model is a distilled simulation of your business. So those 2 things will directly translate. But most importantly is that it's going to control the narrative. So whenever an investor sees your financial model, immediately the first thing they're going to do is they're going to form some kind of opinion on it. This is just human nature. If somebody is giving something to react to, then they will have a reaction to it. So they're going to have some sort of a visceral reaction whenever they see your financial model. And you have to think of the mindset that investors are typically in. Investors are, for a lot of reasons, they're in the business of saying no. They get a lot of deals and they're always looking for reasons not to invest in your business. So if they're given a financial model completely out of context, they're going to be picking through it and looking for reasons to not like your business. And I promise you, they will find them. So you want to be there while that's happening so that you can control how their initial opinion's being formed. It's really easy for an investor to get the wrong impression of a financial model whenever they have absolutely no context for the financial model. And like it or not, once their initial impression's been made, it's super hard to change it. This again goes back to human nature. Once I've planted my flag somewhere, it's really hard to get me to move it, but it's really easy to get me to initially plant it in a different location. So it doesn't matter if the thing that gives them initial pause is really explainable. Once they form that opinion, it's going to be harder to change it. So you need to be there. You need to present your model. And while you're doing that, you need to be in control. Now, I'll call out that these diligence meetings get people really, really anxious. People get really nervous for these types of meetings. They go into these meetings ready for battle. They think that they need to defend their model against the big bad investor that wants to tear it to shreds. And this is a mentality thing. Just don't let that happen. Rethink about the meeting as a working session where you and the investor are working together and you're using the model as a tool to analyze what you think is realistic for your business. So you'll present what you think is realistic, and then you all can have a discussion about that. And if you have different opinions, you'll want to model them out in real time, run a variety of scenarios, ask their opinion, show that you value their input and their expertise. And remember, it's a working session. So you're also showing the investor, you're giving them a preview of how you can work together. I always say that if you're in person, sit on the same side of the table as them, put the laptop down in front and kind of work on it as if you're a team against the model. So that's the way to frame it, is it's me and the investor against the model, not me and the model versus the investor. So be active with them, respond to their ideas, offer some of your own, use it as a presentation, but also maybe a little bit of a brainstorming session as well. And if you spend the time early on and really get to know your model, this shouldn't be a scary meeting at all. And it's perfectly okay to say, hey, I don't know, let me dig into that and get back to you whenever they ask a particularly hard question that maybe you just don't know off the top of your head. That's completely fine. Then after the meeting, you want to follow up. Always summarize what you talked about in an email, and that's when it's okay to include a copy of your financial model, because now you've given them context. So if they want to dig in further, once you've given them that context, then they're free to do so then. We also recommend, if they asked about a specific scenario that maybe you didn't get to in the meeting, then you can spend some time, run that scenario, summarize the outcome, and then maybe send them a second version of the model with that scenario. Maybe if they wanted to see what it would look like with a different revenue model or something like that, or a different growth channel, that's always good to do. And if they asked a question that stumped you, maybe that you didn't know the answer to, again, that's okay when that happens. Just be sure to follow up with them after you've talked to mentors, or go to your team or do some research, and then come back with a really great answer to that question. The team here at Forecastr, by the way, is always game to help answer tough financial questions. So if anybody ever gets those and they're a customer, we're always happy to do that. And then if the investor had said something that prompted you to do a little bit of further analysis in the model, tell them about it, show your work. It's just a great way to earn brownie points and just build more trust and confidence. So in general, you just want to show them that the meeting was productive and that it meant a lot to you. And these, by the way, are incredibly powerful meetings. Once you get to this stage of meeting, whenever they're in the deep due diligence, they're likely pretty interested in your company. So this is more of a closer meeting, whereas the initial pitch meeting, that was more of an opener meeting. So, okay. So now I want to spend a little bit of time going through how I might walk an investor through our financial model at Forecastr. And I'm going to be using real data here, by the way. We'll be going through Forecastr's live financial model as it exists today, just to give you a sense of how I like to think about things and how we tend to tell folks to think about this type of stuff. So if you all are following along on my screen, this is Forecastr. This is Forecastr's financial model. And I like to do what I call the zoom out, zoom in approach when it comes to showing my financial projections. So what I'll do is I'll showcase, high level on an annual income statement, what our, revenue is going to look like at the end of the model. So like I might call out, at the very end of the model, we're generating 30 million in revenue. And at this point we've hit profitability, right? So I'm kind of calling out the scalability of the business and showing, hey, this is going to be a really interesting opportunity. We think that we have the ability to really execute in a big way here. So you're just trying to convey that this is an opportunity worth continuing to pay attention to. So that's kind of the zoom out approach. I've at that point zoomed out, and I've shown you, if we are able to execute in the way that I'm going to be talking about here in a second, this is kind of the light at the end of the tunnel, the pot of gold at the end of the rainbow, whatever analogy you choose to use. This is what we stand to gain if we in fact are able to execute on this plan that we're outlining here. So that's the zoom out. Then I take it to zoom in, right? So once I've shown you that, and hopefully I've gotten the investors really excited about that, now I switch to operational mode, where I walk you through specifically how we're going to be doing that. And to do that, I flip into the assumption section of Forecastr, or if you're in Excel, I'd have something like this spelled out in Excel. But it's essentially walking through, okay, now that I've sold you on the vision, now that I've shown you the big opportunity and hopefully gotten you excited about how big the business can be, now it's time for me to convince you that we've got the operational roadmap in order to execute on this. So I'm going to prove to you that we're going to get to what I just showed you. So to do this, I usually like to start with customer acquisition. So just getting the investor comfortable with how we're acquiring customers and our plan for acquiring customers. And so one thing that I really like to call out here is that this is where bottoms up financial modeling comes into play. Now, if you're not familiar with what bottoms up financial modeling is, it's essentially using your metrics, using, key variables kind of from the bottom up to build up your revenue forecast. So an example of bottoms up financial modeling might be using a budget for paid ads and a cost per click and a conversion rate to understand how many new customers you're going to get. So really digging into specific actions and specific metrics for your business in order to calculate revenue. Now, this is very different than top-down financial modeling, which is something like, our total addressable market is $100 billion. We think we're going to get 1% of that. So I'm going to forecast $1 billion in revenue at the end of the model. The problem with top-down financial modeling doesn't really tell you anything. The only thing that what I just said tells you is that you've got a big TAM. That's about it. I'd say most of us have sufficiently large total addressable markets. So other than that, checking that box for an investor, it's not probably very interesting to them. And then this is also another common method that we see used is this month over month growth of revenue method, where you just take your revenue today, you grow it by 5% month over month. And then at the end of 60 months, you've got this big revenue number. Again, the problem with that, it doesn't really tell you anything. All it tells you is that a compounded growth, like a number that compounds over 60 months, ends up being a big number at the end of the model that we could probably all tell you without having to look at a model. So step one, get a bottoms up financial model. And in our case, we had it modeled out by individual customer acquisition channels. So we can look at, how many customers we're getting from Google, from webinars, from Techstars. We're a Techstars company, by the way. So they give us a lot of leads, strategic networks, all of that stuff. So I can show you our total count for new customers by each individual customer acquisition funnel. And you can see how those total up here. So like in July, for example, we're saying, hey, we're going to get 49 new customers in July. If you want to see the breakouts of how we're going to be doing that, this is how they're going to be broken out. Now, one thing that I'll note here is that when it comes to de-risking this for an investor, what I like to do is I like to go all the way out to the end of my model. So in this case, I'm looking at December of 2026. And if you can see that little hover that I've got over that month, you'll see that the majority of our customers we're forecasting coming from blogs and other strategic networks. So I like to call that out in the investor conversation just to show, look, if you're really looking to understand our distribution, you've got to look really critically at our content marketing and our strategy as it relates to strategic networks. If I can get you bought in and if I can convince you that we have a good execution plan on those two acquisition channels, odds are I can sell you on the entire rest of this financial model. So it shows you that you know where to focus, and it also focuses the meeting in and of itself on the important topics that you really want to make sure you cover. So in this case, because those are going to be our two dominating customer acquisition channels, what I like to do is I like to, if I take strategic networks, for example, expand it out and show that we've operationalized this and that we have a really good head on our shoulders as it comes to executing on growing this particular strategy. Now, this is where financial modeling for operations and financial modeling for fundraising kind of meet in the middle. Because if I've got these metrics out, like in this case, I'm showing for strategic networks that we're going to have, we're going to have 109 partnerships up and running by the end of July. So 109 partnerships, we define a partner as somebody that's got an active discount with us or somebody that's got some sort of a rev share agreement with us. So we're going to have 109 active partnerships. We're going to get an average lead of 0.73 per partnership. That's going to get us 79 beta applications. We're going to meet with 59 of those customers, which that's going to get them to be a deal in HubSpot. Of those, we think we can convert 18 of them. Now, these aren't just numbers that I'm throwing at you that are just coming out of thin air. This is where, we operationalize this model by tracking this stuff every single month. So whenever I tell you, that we're going to convert of the 79 beta applications, 59 of them into deals, that's based off of historical conversion rates. And from deals to customers, again, that's based off of historical conversion rates. The leads per partnership, again, that's a metric that we track. So this is building confidence behind those numbers. And then you're getting behind how you're going to be growing and what you think the future of this strategy looks like. Now, in our case, for partners, for example, we're not really going to be focused super heavily on increasing the leads per partnership. We're going to do our best to keep that flat and not let that, degrade over time as we add new partners. But that's an assumption that we're largely going to keep it flat for the entirety of the model. Our main strategy is just acquiring new partners. So if I'm talking to an investor, I'm going to be talking about all of the different ways that we're going to be acquiring new partnerships. I might talk about what our pipeline of new partners looks like. and talk about interesting strategies that I have for acquiring new partners, and really do my best to de-risk this particular customer acquisition channel, because it's one of the more important customer acquisition channels for my business. Similarly with blogs, I mean, I might call out that we're currently #1 on Google whenever it comes to financial modeling financial modeling software, right? I might talk about our blog strategy, guest posts, things like that. Just really give them confidence that, we are going to be able to execute on a really good content marketing strategy. But the tip here is just, you've already zoomed out, you got them bought in on the financial gain that's expected. Now it's time to de-risk the plan for them. By doing so, or the best way to do that is to zoom in on the most important customer acquisition channels and de-risk those. Now, once you've done that, I like to flip it over into talking about how we are going to essentially turn those customers into dollars. So in our case, we talk about the different packages that we offer. And in fact, in our case, we only have one package that we offer at the moment, which is our launch package. But I might talk about how we upsell those and how we can expand our ACV over time by offering analyst support packages and fractional CFO packages, and how one customer might have an ACV of, upwards of $6,000-7,000, even if it's just a very basic $2,000 software package. This is also where I might call out trouble metrics kind of on the front end. So in our case, our annual churn rate is something that we're hoping to beat down. We sell to a lot of really early stage companies. The problem with early stage companies is they tend to fail sometimes. So that translates into a pretty high logo churn rate. So I might use this time to, instead of trying to hide that and try to get it to where, maybe I'll get an investment without them realizing, I like to call that out on the front end. And I like to put it front and center and tell the investor about the strategies that we're using to beat that down. We're going to later stage companies maybe, or we're doing a more dedicated customer success program or something like that. But don't hide behind your trouble metrics, put them out front and center. If you have them, you saw in the case of churn rate, we have that decreasing over time. Just add a little bit of narrative behind that. And that's also going to help de-risk the revenue for the investor. So that's always really important as well. So I like to go to team next. So I go to how I'm getting customers, how I'm turning those into dollars. Now this is the team that's going to execute on this vision, right? So a lot of times we're going to be spending the investor dollars on building out our team and executing on getting a lot more people into the business. This is where you can talk about that. So you can go into, these are the key people that we're going to be hiring. Maybe I'm giving raises to people that are here that have worked really hard to reward them. But essentially, whatever your strategy is for growing the business from a personnel perspective, I like to talk about that because this is the first segue into our use of funds discussion. This is how I'm going to be using the funds that we're going to be needing to get this business off the ground. And then I continue that by talking about the other expenses as well. So this is where I go into things like cost of goods sold or any kind of general and admin expenses that I have, or if I have a lot of software that I'm spending money on, or perhaps I want to go into a detailed marketing budget or something like that. I'm really just expanding upon the use of funds here and just giving them a sense of this is why we need, if we're going to execute on that, we're going to have some hefty expenses. And this is why we need to talk to investors. And to really hammer that point home, I like to go to the statement of cash flows. And this is where we're forecasting what our cash balance is going to look like. And if I'm looking at our financial model, if I scroll to the right, we're forecasting currently a cash shortfall in July of 2023. So we know that, for our business, we're going to need to execute on a fundraise before July of 2023 to make sure that the business is going to have enough runway to execute on that vision that I showed you initially with the high revenue growth. So in this case, I might say, we're looking to close a round of funding before now. So maybe, April, May, June, that time frame. And to give you a sense of kind of how far cash goes negative, I might zoom out 18 months past that date, look at what a negative cash balance is, and use that to kind of justify my fundraise. So, just to make sure that I've got enough cushion there that it makes sense to the investor as to why I'm raising that much money. So you can see here how powerful a financial model can be, because it's a really great communication tool where I'm showing you what the vision can be. I'm showing you how big the company has the potential to be. I'm showing you exactly how we plan to get there, all the way down to the metric level. I'm also giving you a sense into our operations of how we track this stuff and how we think through this stuff ourselves. I'm giving you a sense of how we're going to translate that into revenue. What does our revenue formula look like, right? So that they get a deeper understanding of how our business actually works from a revenue generation perspective. I'm giving you a sense of what our team's going to look like, and what that expansion might look like, and what we're going to be spending money on, and also give you a sense of runway, and why we need to raise how much we raise. So that really gets into that uses of capital. So that's really kind of a lot of the value prop that a financial model can bring whenever it comes to fundraising. So hopefully that's very useful. And I know that we've only got a couple minutes left, then we want to get into Q&A. So I'll kind of wrap things up here just by saying, hopefully you found this stuff useful, and I want to extend a 25% discount to anybody that is on this webinar. If you are interested in Forecastr, like I said, we'd love to work with you, just to give you a sense of pricing and everything, because I like to be really transparent about that. Sticker price is $2,000 a year. Now this will knock $500 off that with the 25% off. So that's going to be $1,500 if you're interested. That isn't just the software, by the way. That comes with 30-day white glove onboarding. You'll be paired up with a financial analyst that's going to learn all about your business. They're going to help you build out that financial model, help you understand your metrics, and get you ready for that fundraise. So with that, I think it's right at 15 minutes left. So I will pause there, and we can get into questions.
Awesome. Thank you so much, Logan. Yeah, that was a super information dense presentation. And yeah, we've got a lot of questions. So let's just kind of get to as many of these as we can. So you can keep putting them in the queue, but I've got some queued up to start asking. So a couple of these questions, I guess the biggest theme is about communicating financials to investors. So the first question related to that is from Arafat, who's asking, with the current market conditions, valuations potentially dropping and fewer investments being made. He says, what figures within the financial model do you see investors are looking at particularly closely? And Julia asked a very similar question in here, I think. But is there anything you think that they should focus on very specifically right now?
Yeah, so I wouldn't say that I've seen anything change significantly. Like, I don't think that they're actually looking at different metrics today than they were, say, 6 or 8 months ago. But what I will say is they're looking at the metrics they used to look at a lot more critically. Right. So fundraising is a lot harder today than it was several months ago, obviously, with the markets being as challenged as they are. So it's even more important to have a deeper level of separation between you and other companies that are fundraising. And maybe even a better way to say that is, you want to give them as little reasons to say no about your business as you possibly can. And a financial model is certainly one of those things that's going to be really helpful when it comes to due diligence. One thing that we recommend in today's kind of more challenged environment is just show an investor what you think and hope is going to happen with your business. And then into your back pocket, show an absolute worst case scenario where, in our case, for example, when we raised our pre-seed round, we said, what if we didn't generate any revenue for 18 months? Okay. Now we're going to raise off of that. How much cash would we need if we didn't generate any revenue? And that way, it may sound counterintuitive, but that's actually showing that you're a good fiduciary in and of itself, because you're saying, look, we're not betting the company on this outcome, right? We hope for this outcome. We're going to try to get this awesome outcome for everybody, but we're not betting your dollars on that. We're going to be ultra conservative, and we're going to plan on us hitting something significantly less than that, just to make sure that we're going to have enough time to figure things out if we fall short.
Yeah, that makes a lot of sense. Two other questions that are both sort of related to investors. So one from Mohammed and one from Julia, and I think they both kind of relate to what you were saying at the beginning, the sort of before, during, and after that pitch meeting. So Mohammed asks it this way: for pitching investors in a seed round, what are the key details to be shared in the deck? And Julia asks very similarly, if we don't show the full forecast in that first presentation that we send, what kind of financial data should we add on those slides? So I think you covered that, but do you want to just rehash that for Mohammed and Julia quickly?
Yeah, no, absolutely. So what do we like to show on the slides? I'll say typically whatever is going to prompt the investor to say, I want to understand the logic behind those. And the one that I usually say is, like, get a revenue curve out there at least. That's kind of the minimum, just to show forecasted revenue over 5 years or so. So that way, if they're seeing like a good curve that ends up being, $100 million per year in revenue or something like that, that at least lets them know like, hey, this checks the box that this is a big enough opportunity that I should pay attention. Now, if I am interested in the business, it's time to actually dig in and see what those numbers are made of, right? So that's what you're trying to get. That's the hook piece of financial modeling when it comes to the pitch deck. It's just you want them to ask the question so that you've got them on the hook for another meeting, right? And then in terms of like where to focus, I would say this is always kind of challenging for really, really early stage companies. I'll share this. Whenever we originally went to market, Forecastr was actually, we thought we were going to be a freemium model until we ourselves put together the projections and we realized that that was never going to work with our market. Like we weren't going to be able to pull off a freemium strategy. Same deal, you just want to think through your revenue formula. You want to show that you've given some good thought as to kind of the mechanisms of how revenue is going to work and be able to speak intelligently about that. We always tell folks, focus on revenue first if you're really, really early, and then button up the rest of it as you go.
All right, perfect. There's two questions here from Tim. I'm going to kind of ask them both in turn. The first one's a little confusing to me, so if it doesn't make sense to you, you can skip it. He says, with what's going on in the capital markets for seed and Series A, should we separate operations and development in the capital campaign based on those level of efforts? I'm not sure if I can completely decipher that, so take it or leave it. But he also asks if you could review CAC, cost of customer acquisition, and LTV and the ratio. So I know you showed those in the tab really quickly, but are those kind of metrics, I guess, that are really important that you would that emphasize?
Yeah. So I'll take my crack at the first question. I'm not sure if I completely understand it as well, but I think it's like, how important is it to delineate costs between like development and maybe other operations, just to show we're spending money on X rather than Y in more challenged environments? I would say, again, I don't think that the environment's really dictating whether or not that's important. I think that that's generally pretty important, and investors just focusing more on financial modeling today than they were, like I said, 6-8 months ago. So that's always good to do, just to give an investor a sense of like where you're going to be spending the money, having a more holistic budget, just showing you where everything's going so that they can understand, hey, these people aren't spending all of my money just on founder salaries or something like that. Maybe they're spending it more on product development. Second part of that question, talking more about the unit economics, CAC, LTV, all of that good stuff. Incredibly important stuff. Even at the seed stage, we like having at least estimations of those pretty well buttoned up. That's going to be the key, really. The unit economics are going to be the key to understanding if your business is going to scale or not. So whenever we're talking about at the very early stages, like pre-seed, seed stages, just getting a handle on your revenue formula and getting a sense of, is this actually going to scale? The unit economics are really what I'm talking about. Is like, is my LTV going to be high enough for my market? Is my CAC going to be too high? All of that good stuff. And this is all stuff that we focus on really heavily in onboarding, making sure that we get you buttoned up there here at Forecastr. So that's all stuff that we'll make sure that you walk away with at the end of onboarding.
Yeah, really important, I do think, Tim, to kind of have quick answers specifically for those acronyms that like tend to come up all the time in your unit economics. It's good as a founder, even at an early stage, to kind of have a prepared answer once you work through your financial model. But great question. Here's one from Nezra, who's asking, I love the presentation, Logan, what are some of the assumptions that you incorporated since they make or break the model? And I guess this kind of speaks to when you were saying I really liked operationalizing your model from historical data, but are there other kind of core assumptions that you would highlight that go into your model or model in general?
Yeah, it depends on the business entirely, but what I always like to say is assumptions aren't created equally. And this is one of the biggest powers of financial modeling. It's actually personally one of my favorite things about financial modeling is what you're really trying to do, specifically with revenue, is you're trying to distill it down to the individual actions that you have to take, so that at the end of it, you've almost got a roadmap, like a game plan for how to get to your goals. So in the example that we went through, we spoke briefly about our strategic partnership strategy, and I had a number of partners growing over time and our activation per partner staying relatively flat. So, Jeff is on the call. He's our director of partnerships at Forecastr. So Jeff knows, for me to be successful, I need to take us from 109 partners right now to 170 by the end of the year. So he's got to operationalize that and get to that, but it's showing the metrics of this is where we need to be, and if we can execute on that, then the rest of it's just math. It'll all flush out, and we'll end up getting the customers that we need to. And it totally depends on the business. What we like to do is we like to set up a financial model and work with our founders to figure out what their customer acquisition formulas look like. Maybe more people are using paid ads. Maybe more people are using, events like going to TechCrunch Disrupt or something like that. They're going to more of those types of things, and setting it up for them specifically. And then we can tweak things and see what has the biggest impact on revenue. And for us, I can tell you, I mean, we talked about it whenever I was going through our model. It's all comes down to partnerships, and it all comes down to our content marketing. Our partnership strategy is about 3 times more impactful to us than even our churn rate is. And I know that because we've just put together our financial model and we know our numbers really well. But that's really the which assumptions are the most important. Totally depends on the business. I encourage you to put together your own financial model, and you'll have an answer for yourself.
Yeah, that's the power of the model, and then of operationalizing it so that you can kind of wrap or get a little tighter around those assumptions. So yeah, that makes a lot of sense. Question here from Mohammed says, our startup has patents. How do we recognize those patents in our financial model? This would normally be like an asset. This would go like on a balance sheet. Is that a part of the Forecastr model, or how do you think about how a patent might fit into a financial model?
Yeah, that's more of an accounting question, but I'll answer it nonetheless. Is that, yeah, typically you're going to hold patents on the balance sheet. You're going to spend money on getting the patent, and then you're going to be able to capitalize that just to show it as an asset. But yeah, again, that's more of an accounting question, but we can certainly model that out in Forecastr as well, just showing the cash outflow of getting the patent done.
Awesome. Here's a question from Joe. He says, our issue has been using a growth rate over time, which doesn't allow for showing growth based on various future inflection points, such as a future funding round. He says, do you suggest manually adding core metrics that will extrapolate through the rest of the model? So I don't know if I'm understanding that correctly. Like, there's going to be these inflection points that happen, and how do you think about showing that in the model?
So completely understand the question. I will say that I'm not at all a fan of just using growth rates over time. Again, it just doesn't tell you anything about the business. It doesn't tell you what specifically you're doing in order to achieve that growth. But to answer your question, let's say you hit funding, right? You get some funding. Well, you got to think, okay, what specifically is that going to change about my business once I get, say, $1 million into the bank? Well, maybe I'm going to hire a sales team. Maybe I'm going to dump that into paid ads. Maybe I'm going to invest that in content marketing. So we'll use paid ads as the example. Let's say now that I've got more money, I'm going to devote $10,000, $15,000 a month to paid ads. Well, I can input my paid ads. I can figure out what my cost per click is. That's going to give me a sense of how many leads I'm going to get. Then I can look at what conversion rates are typically for my industry. That's going to give me a better sense of what to expect with those dollars. So I'd encourage you to think more of it like that. Like, once I get the money, what am I going to do with it? And once you do that, and once you've done that really thoroughly, you can understand how that answers all kinds of questions about your business and really helps de-risk it for investors as well.
Yeah, absolutely. Here's a question about general macroeconomic factors right now from Segan, who's asking about inflation. He said, I didn't hear you. You mentioned about economic issues like inflation in your presentation. Is inflation something that should be factored into folks' financial models as they kind of face a different economic environment now than perhaps founders have in recent decades?
So I don't, but I'm not like categorically opposed to including inflation in a financial model. But I'll give you my logic at least as to why I don't. It's because inflation is going to affect everybody. Generally, it's like, if what I'm trying to showcase with my financial model is like my execution plan, is just like showcasing like essentially the things that are interesting for my business. But inflation's not really, I mean, it's going to essentially just affect me just like it affects somebody else, just like it affects somebody else. So I don't usually spend a whole lot of time like focusing on inflation. Now, the one thing though that might make sense is just having a little bit of an extra buffer in your expenses, just to make sure that inflation doesn't cause you to have a unforced cash shortfall. And what we typically do there is we say, figure out how much money you think you need based off your financial model. Again, like a worst case version of your financial model, and then throw 30 to 50% on top of it. So with a high inflation environment, I might steer you more towards that 50% than that 30%. But as far as like including it as a metric in your financial model. I typically don't worry about that, but I, again, don't really have a huge reason against it. It's just not something we do.
Yeah, makes sense. We're getting really close to the end here, so I want to be respectful of your time and everybody in the audience time who's joining us here today. I guess I'll end on sort of one question from Cindy that I think is a good question to end on, and I saw Jeff and the folks from Forecastr jumping in and answering some of these questions. But Forecastr is for the life of your company, right? So she asked, does it move into later, more mature financial modeling at scale, beyond your, say, Series A funding round? That's the answer is yes to a question like that, right?
Absolutely. Yeah, we're here for the long haul. And even better than that, we have packages that are going to help you scale. So maybe you're early and you just need the subscription, then you get some cash and some traction, and now you want to work more hand in hand with an analyst, more dedicated. And then you go even further than that. Now you need a CFO. Then we'll literally help scale up as you grow. So it's very much from early stage all the way up well through a Series A is where we focus. We have plenty of Series B, Series C companies on the platform as well.
Awesome. All right. Well, I guess just kind of last chance to give any closing tips. This has been a really wonderful, Logan. But yeah, anything that you want to kind of end on a parting thought here for founders who are joining us?
I've pretty much covered it, but I'll just say, if you choose not to use Forecastr, just please devote some time to building a financial model, whether it be a template, even one of our competitors. Just do it. It will pay dividends down the line. I promise you. That's my biggest tip that I can give, is just don't ignore it. Just don't ignore it.
Absolutely. I think that's great advice for every founder here who's joining us on the call. So thank you so much, Logan and the team at Forecastr who is there in the chat helping to answer questions. Thank you to our producer, Felicia, in the background. Everybody who registered here will get a copy of the recording of this webinar in their email in about 2 days. So thank you again for joining, everybody. Have a great rest of your week and stay healthy. Thanks for joining.
Thanks for having me. Appreciate it, guys. Okay, bye.
Bye.